Hey, this is Chris. Now, I started StockSpot about 8 years ago, and over those 8 years, I can't count how many times I've been asked by people, are ETFs or is index investing a bubble? In fact, this question comes up multiple times a year, and it's usually caused by some sort of article that's been written that's recycled the same silly arguments about why index investing based on their arguments is a bubble. So in this video, I'm going to be addressing some of the common explanations given for why indexing is a bubble and explain why that isn't really the case and why it's usually just active fund managers trying to justify their unbelievably poor performance. So myth number one is that indexing makes all shares move together, and therefore that's why it's causing a bubble. Now, this is obviously ridiculous. ETFs have absolutely no influence on what companies come into an index that an ETF tracks, and ETFs also have no influence over the weights of those securities within an ETF. In fact, all of that is determined by active managers, active participants in the markets who are buying and selling securities between each other. And that's why even within most ETFs, there are companies that are going up in price and companies that are going down in price. This is not because of the ETF, but because there are buyers and sellers determining that the prices of those securities should be higher or lower. So no, it's not true that ETFs are causing a bubble because they move shares together. In fact, shares within an ETF very rarely all move together, and they're usually moving in quite different directions. The second myth is that ETFs misprice shares. So they basically make some shares overvalued and some shares undervalued. Now, this argument almost exclusively I see coming from active fund managers who have underperformed. And they're looking for someone to blame for their underperformance, and they basically say, look, it's the ETF's fault. They're basically buying all the shares I don't own and not buying all these great companies I do own. Now, this is another ridiculous suggestion. ETFs have almost no impact on share prices, and even in countries like the US, where indexing and ETFs are becoming a larger and larger proportion of the market, getting closer to 50%, they still only make up about 5% of the trading within that market, which means that 95% of the trading is active fund managers trading between each other, determining the price. And so ETFs actually have almost no impact on the prices of securities. In fact, active managers are what's determining prices, and therefore ETFs aren't having an impact on mispricing shares. The third myth I see often around ETFs and whether they're a bubble is that they're causing certain segments of the market to become a bubble. You know, whether it's tech shares or another sector of the market. The myth goes something like ETFs and ETFs following that sector of the market are causing the bubble. Now, this ignores the fact that ETFs didn't exist for many bubbles in history. The South Sea bubble, the dot-com bubble, the Poseidon nickel bubble. In fact, there's been plenty of examples of booms and busts in history where ETFs didn't exist. And the reason is that it isn't ETFs or a certain product structure that causes booms and busts. It is people. It's the behavior of people that causes shares to go up too high and to fall too low. It is really behavior and not any sort of structure that causes this. So certainly there will be ETFs that do track a particular area of the market that goes up very fast and may come back down, and maybe that is technology, maybe it's mining, who knows what it is. But ultimately it's not the ETF that's causing markets to go up and down, it is people buying and selling. And in the past, it would have been buying and selling direct securities, direct shares in that sector, or it might have been investing in managed funds. Like in 1999-2000, when there was a huge number of launches of new managed funds investing in this hot sector of tech. Now, these were active funds. Now, maybe it's ETFs that people are more interested in, but regardless, it's not the ETFs that are causing markets to go up and down. It is behavior of the people. Now, if you want to hear my full response to these ridiculous suggestions that ETFs are a bubble, you can check out the link below in the comments section where my blog really illustrates a lot more examples and goes into more detail. And if you like content like this, please subscribe to our channel.